Check, check. Fine. Now, my dear students, what are we starting with? We are starting with your WACC calculations. Okay, weighted average cost of capital. Okay. Now see, as we have discussed, whenever we are dealing with your WACC, what's the first thing which you have to understand? We need to check that how are we going to raise the funds. Okay. Whether there is one source or there is going to be multiple sources on the basis of which we are going to raise the funds, beta. Multiple sources, and we are required to calculate now what is the overall cost of capital. Okay, so multiple sources and overall cost of capital, that needs to be taken into consideration. Okay, see here we have to check whether there is book value weights, market value weights, or marginal value weights. Okay, but before that, first let us read your illustration number 16. Cost of equity of a company is 10.41% and cost of retained earning is 10%. Here in this particular case, is the KE and KR different? Come on here. So in market value weights, are we going to consider KE and KR both the things separately? Come on, yes or no? Yes. Because your KE and KR is different. If your KE and KR would have been the same, then in market value weights, we would have only considered market value of equity. But here your KE and KR both are what? Different. So that is why we have to calculate what should be your WACC. Okay. There are 50,000 equity share of rupees 10 each and the retained earnings is 15 lakhs. Market value per share is 50 rupees. We are required to calculate WACC using market value weights. Now please tell me, to calculate your WACC using your market value weights, we will have to take into consideration your equity also and reserves and surplus also. Both these things are going to be there, equity as well as your reserves and surplus. Can you please give me what is your market value of equity? Can you just check market price of the share is what? 50. And what are the number of equity shares? There are 50,000 equity shares. So what will I do? I will take 50,000 shares and multiply that by 50. Will that give you market value of equity? Come on, yes or no? Yes, sir. Can you please give me what's the market value of equity, beta? 25 lakhs. And they have told you that the retained earnings is for 15 lakhs. Now, my dear students, if there would only have been KE and KR would have been the same, then I would have written only equity 25 lakhs and I would have done it accordingly. But in this question, my KE and KR, is it same or it is different, beta? So that is why I have to write down your equity also and I have to write down your reserves and surplus also. So this 25 lakh rupees, which is market value of equity, I have to divide some part in equity and some part in reserves and surplus. So what should be the proportion in which we have to make this division? So that proportion has to be your book value weights. That proportion has to be what, beta? Book value weights. So do you have book value of equity share capital? Yes. 50,000 equity share of rupees 10 each. So can I say that is 5 lakhs? And reserves and surplus has a book value of what? 15 lakhs. So can I say I have to now divide this in the ratio of what? 1:3. So now this 25 lakhs, which is the total market value of equity, I need to divide this in the ratio of what? 1:3. 1:3, sorry. So 1/4 and 3/4. So please take 25 lakhs, divide that by 4. Can I say 6,25,000? That will be your market value of equity. And from 25 lakhs, if I subtract 6,25,000, what's my reserves and surplus, which is coming as 18,75,000. And do I have the KE percentage given to you? Yes, sir. How much is that? 10.41. And what's my KR percentage which is given to you, beta? That is given to you as 10%. Now, what is this weights which is going to come? So can I say my weights will now be 6,25,000, divide that by 25 lakhs. What is this coming as? 0.25. And what is this which going to be coming as? 0.75. So you take 0.25, multiply that by 10.41. that is going to be your 2.6025%, and take 0.75, multiply that by 10, that will be 7.5%. What is going to be the total of this? 10.10. This is nothing but your KO. So your KO should be nothing but 10.1%. Are you guys trying to understand this? Okay. But for that, what did you understand first? That if the KE and KR would have been the same, then entire 25 lakh rupees was nothing but market value of equity only. And we would have considered that KE only as your KO. But unfortunately, what is happening? That KE and KR both are same, or KE and KR are different, beta. Different. So it is important that what are we going to do? We will have to definitely do the bifurcation of this 25 lakhs on the basis of book values of equity, share capital and reserves and surplus. And based on that, we calculate your KO, and that KO turns out to be your 10.10%. Convinced? Everyone's okay with this? Okay. Then question number 17. We are required to calculate the WACC using book value weights and using market value weights. So guys, here in this same question, we are going to use book value, market value both. And whatever the data which is given to you, that is the capital structure of the company. So all these values which are given to you, that is your book values, or these are your market values, book values. Because this is from the capital structure of the company. Capital structure of the company means what? Whatever is there in your book value, we are taking that into consideration. Okay. And now the market prices are given to you for each of the securities, which are debenture 105, preference share 110, and equity shares 24. Now, what is the additional information which is given to you? Rupees 100 per debenture, redeemable at par, 10% coupon rate, 4% flotation cost, and 10 years maturity. 100 preference shares, redeemable at par, 5% coupon rate, 2% flotation cost, and 10-year maturity. And equity share is 4 flotation cost, market price is 24 per share. Then next year expected dividend is 1, growth rate is 5. The firm has the practicing of paying all the earnings in the form of dividends. Corporate tax is 30%. Use YTM method to calculate the KD and KP. So to calculate KD and KP, which method we are going to use? Beta, YTM. So when there is YTM approach, then in that particular case, don't you think we do that by the way of that table, trial and error method? And based on that, we will get the percentages on the base of which we'll be getting your KD and your KP. So can I use the formula for KD here? No. What do I have to use? Table, and use interpolation and use trial and error method for the purpose of getting the answer. Okay. So even they have done it on the same basis, and they have taken the range and they have calculated. Can you just check? See, they have used the word IRR. So based on IRR, we calculate your K and KP, and then finally we'll be getting the final answer. But always remember, whether there is book value weights or market value weights, just check. Do you have this after-tax cost of capital same? Then the answer is yes. So whether there is book value weights or whether there is market value weights, the cost which we are going to calculate, that is going to be calculated in the same way only. But the only thing is the difference will be in the weights part. So your KO is going to be different, but the KD, KP and KE which we are going to calculate, will that be constant whether there is book value weights or whether there is any market value weights? Your KD, KE and KP is always going to be the same. This question, I want you all to solve this along with me. Go to your notebooks and we'll do this together. Okay. Let's practice this question. So now we are calculating question number 17. Okay. Okay. So let's do this together. Okay. So now this is which question? Beta, question number 17. Illustration 17, which we are solving it. Okay. Now, see, first what you should do is you should prepare a table. Calculation of WACC using book value weights. Hello. And here we'll be writing down sources, amount, weights, COC, WACC. Okay. Can you please tell me how many sources are there, beta? 3. Debentures, preference shares and equity shares. Okay. And similarly, we will prepare one more table, which is calculation of WACC using what as weights, beta? Using market value weights. Same process will apply sources, amount, then there will be weights. Come on here. There will be cost of capital, there will be WACC. Okay. So sources will also have what? Debt, preference shares and equity shares. Okay. Now, what is the amount column? Can I say if it is book value weights? If it is book value weights, can I say I should take balance sheet values? So it is going to be the same only, 5 lakh, 5 lakh and 10 lakhs. So this will be 5 lakh, this will be 5 lakh and this will be what? 10 lakhs. So what's the total? 20 lakhs. Can I get the weights, guys? What is my first weight? 0.25. This will also be 0.25. This will be 0.5. Now, in your debt market price, have they given to you market price, guys? What is the market price they have told you? What is the market price they have told you? 105. So now I have to check what are my number of debentures. See, this is 5 lakhs and the face value is 100 rupees. What are the number of debentures? 5,000 is the number of debentures. Okay. And these 5,000 debentures, now I need to multiply it with what rate, beta? Market price, which is nothing but what? 105. So give me what is this going to be? 5,000 multiplied by 105. Tell me what is this? 5 lakh 25. Come on here. 5 lakh 25. What about preference shares? For preference shares, this is 5,000, 5 lakh divided by 100 each. Can I say this will be nothing but 5,000 preference shares? I need to multiply it with what price, beta? 110. So this will now become what? 5 lakh 50,000. And the last case, just check what are the number of equity shares. 10 lakh divided by 10. How much? 1 lakh shares. And I will multiply that with the market price. What is the market price, beta? 24. So what is this going to be? 24 lakhs. Hello. Now give me the total of this. Yeah, how much is it? 34 lakh 75,000. Everyone's getting this as 34 lakh 75? Okay. Now give me weight size. Can I say the first weight will be 5 lakh 25 divided by 34 lakh 75,000? What is this? 0.15. Then point. So see, this is 5 lakh 25 now. You divide that by 34 lakh 75. This is 0.151. I am writing it down. And then 5 lakh 50. If I divide that by 34 lakh 75,000, this is 0.158. So I'll write down this as 0.16. Let us take only up to 2 decimals. 0.15, 0.16. And what about the last case, 24 lakh? If I divide that by 34 lakh 75,000, this is 0.69. The total has to be 1. Just make sure. Okay. So they have taken up to 3 decimals. I am just taking up to 2 decimals. This answer is going to be the same only. Okay. Chalo. Now let's talk about KD. Are you all okay with this much? Okay. Weights is done. Now let's talk about KD. So KD, how are we going to calculate, beta? By using the formula or by using YTM method? YTM method. So for YTM, you all will now prepare working note number 1, KD using YTM. Okay. We are calculating KD using which method, beta? YTM. So when we are calculating KD using YTM method, what are we doing? There will be years. What is the life? Now let us read all these things. What is given to you in the question? That rupees 100 per debenture redeemable at par 10% coupon rate, flotation cost is 4%. So first of all, here 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And now I'll be having interest also and I'll be having redemption value also. Right? So what is the interest? Interest is always on the face value. So coupon rate is 10%, face value is 100. So interest will be 10 into 1 minus what's the tax rate? 30%. Come on here. So that is going to be 7. Come on. So this will be 7 for the period of 10 years. And then at the end of the 10th year, don't you think there's going to be redemption also? And is the redemption happening at par, premium or discount? Par. So can I say you will be getting 100? So that will be 107. Are you guys getting this? So this will be 107. And now let us discount it at how much percentage? Now see here, what is going to be your net proceeds? Just check. Here there is 4% of flotation cost. Everyone take on your calci 105 because 105 na. Just check what's the market price beta? 105. Now market price is 105 and flotation cost is how much percent? 4%. So can you please give me what's your net proceeds? 100.8. So your target is to get 100.8. Your target is to get what? 100.8. This should be your present value. Your target is to get 100.8. Now to get this 100.8, we have to discount it. Now what should be the range of the discounting factor? So now we will take the discounting factor. Let us try it at 5%. Let us try it at 5%. Trial and error basis. You can also do it at 10%. You can also do it at 8%. You can also do it at 2%, 3%. We are trying it at what percentage? 5%. Okay. I'll give you one very shortcut method. Okay, how to determine the range. So I'll tell you. Though they have not told you using the formula, but I want you to use the formula once. Okay. Use the formula and give me the KD. KD will be interest into 1 minus tax, that is 7. What is your RV? 100. What's your NP? 100.8. What's your life? 10 years. Okay. And then you take 100 plus 100.8 divided by 2. I know they have not asked you, but just calculate like this. So this will be now what? 100 minus 100.8 divided by 10 plus 7. So this will be 6.92 and 100 plus 100.8 divided by 2. That gives you 100.4. So now you take 6.92, divide that by 100.4 into 100. You should all get this as 6.89%. So did you realize one thing? That if this is 6.89%, it means that your IRR range will be somewhere between 5 to 10%. Hey, hello, did you realize that it should be somewhere between 5 to 10%? Okay, so if you want to know what should be the starting point, so you can just make this in rough work. Barabar. You just make this in what? Rough work. So you come to know that this is 6.89%. Then you will realize, oh, this is 6.89%, which is falling between dash and dash, 5 and 7. So can I say now I can take a range of 5 and 7 and do it accordingly? Come on, yes or no? Yes, sir. Did you realize this? Okay. But let us not take 5 and 7. Let us take 5 and 8. Because sometimes you do rounding off now, then at 7%, I think things will not be possible. So let us take 5% and 8%. But definitely it's not 10 and 15. Are you understanding? So by using the formula, at least you will get a percentage. On that basis, you get a range. So now let us start at 5% and let us check what's the PV which you are getting. And then try it at 8% and just check what's the PV which you are getting. Okay. So at 5%, let us calculate this. 1 divided by 1.05. Now see, for 10 years now, this 7 rupees is same. So can I use present value annuity factor? Okay, so I'm just giving you a shortcut method. I will explain you this in investment decision, but the 7 rupees is constant, right? For every year. So instead of taking each and every year PV factor, can I combine all the PV factors and get this, which is called as actually your PVAF? present value annuity factors, that will make your calculation much more faster. So I will tell you what you should do. Take your calci, take 1 divided by 1.05. Okay. Now press is equal to. Can I say you all have got 0.95238? Come on here. This is the PV factor for 1 year. Press it 10 times. Matlab this is for the first year. Press for the second year is equal to. Press is equal to third, fourth, fifth, sixth, seventh, eighth, ninth, 10th. Are you all getting 0.6139? Okay. Now press GT. I hope you all have GT. Press GT on your calci. You should all get 7.72173. Now you multiplied that by 7. You all should be getting 54. So can I say present value of interest is 54.05. Now calculate what is this 100 rupees which you are receiving at the end of the 10th year. Because I have already considered interest of 7 rupees. So now what is remaining is 100 rupees which you are getting at the end of the 10th year. So now whatever you got now 54.05, put that in M plus. Put that in M plus. Now press 1 divided by 1.05 and press 10 times is equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You should all be getting 0.6139. Then you multiply that by 100 rupees. Okay. And press M plus again. So this 100 rupees present value is nothing but what? 61.39. Now press MRC. You will come to know, oh, this is coming as what? 115.44. This is coming as 115.44. Is this 115.44 greater than 100.8? So at 5%, definitely it's not the discounting factor. Now let's check at what percentage? 8%. Again, 1 divided by 1.08, press 10 times is equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And then press GT. You will be getting 6.71 something something. Multiply that by 7 and put that in M plus. So you should all be getting this as 46.97. Then once again take 1 divided by 1.08. Press 10 times is equal to 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You should all be getting this as 0.46319, which you multiply again by 100 and put that in M plus. That is 46.32. So what's the total which you are getting? 93.29. Now is this less than 100.8? Hello? So now have I got the range? At 5%, what is this coming? 115.44. At 8%, what is this coming? 93.29. Now have I got a range? Because I want to get 100.8. Is 100.8 falling between 5 and 8%? Come on, yes or no? Yes, sir. So it is more than 5, but it is less than 8. Now please tell me what's the difference between 5 and 8? 3% is the difference. Now at 3% difference, how much have I discounted? So that is 115.44 minus 93.29. Can I say I have total discounted 22.15? But I don't want to discount 22.15. From 115.44, I just have to reach how much? 100.8. So now in this particular case, 115.44, if I subtract 100.8, what am I going to get? 14.64. So now can you please tell me 14.64 into 3 divide by 22.15. How much is this beta? 1.98%. So if I take 5 plus 1.98%, what am I going to get? 6.98%. And if you guys just check, the answer for this is 6.89%. Our answer is 6.98%. Have you guys got this? So if you take 5 and 7 exactly, you'll be getting 6.89. Okay. But if you do it like this, you'll be getting 6.98%. Absolutely perfect. Perfect. Okay. Everyone got this? Same approach, can I say you can also do it for KP? Right? For KP, you can also calculate your KP formula. And based on that, you will be able to get what is going to be that percentage. And once you get that percentage, the range will be very much applicable for you. Okay. That you can practice on your own. I'm not doing it here now. Okay. But on that basis, you will calculate, you will be getting the KP, and the KP is coming as 4.08. So ultimately, this will now be debt 6.98, 6.98. Can I write down debt? Both the cases same cost. Solo yaar. Then KP 4.08, 4.08. Okay, this is coming as 4.08. And then we are just required to calculate your KE. Now for your KE, what have they told you? That for your KE part, they have told you that there is a flotation cost of P4, market price is 24, and next year dividend is 1. How will you calculate KE, guys? D1 upon net proceeds into 100 plus G. What's your D1, guys? What's your D1, everyone? So this will be 1. What's your net proceeds? Can I say it will be 20? From 24, I'll subtract 4 rupees flotation cost, it will become 20. Multiplied by 100, and what's your growth rate? 5%. What is this answer? It should be coming as 10%. So that's your key, 10%. And then you all know how to calculate your KO. You all have to just multiply this, get this WSCC, you will be getting your KO part. Superb. Everyone's okay with this? Sure, confident? Perfect, great, amazing. So with this now, your question number 17 also gets completed. Okay. Now let's do this question number 18. Now this is slightly difficult, but yes, important from the examination perspective. So we'll be doing this question number 18. Okay. So I have revised entirely book value weights, market value weights. Now this is one of the question on marginal value weights. This is something which we're going to discuss. Okay, so get ready for this question. Very nice question. Okay. Now, what is going to happen in your question number 18? Okay, pay attention to this. Very, very, very important. Okay. ABC has the following structure which is considered to be optimum. Now, whenever you see the word optimum, now for this particular question, you have to use a very different approach. Okay, now what is this optimum word? Suppose a company tells you that we are having debt equity, okay, and 60% of debt and 40% of equity. This is the optimum structure. So what is the optimum structure, guys? Debt should be how much? 0.6, and equity should be how much? 0.4. Now, company has already raised 5 lakh rupees. Can you please tell me how this 5 lakh rupees is being raised? 60% debt, it means 3 lakhs. And 20% equity, 40% equity, that is nothing but 2 lakhs. That's how they have raised the capital. Now, company wants to raise another capital. Suppose company wants to raise now more 1 lakh rupees. But in what weights will they use 1 lakh rupees? How will they raise 1 lakh rupees? So when they have given the word optimum, can I put it like this? That this 1 lakh rupees is actually raised by taking 60% debt and 40% equity only. Because in the question, do you have optimum capital structure given to you? Come on, yes or no? So that is why, how much are we going to raise by the way of debt? 60. How much are we going to raise by the way of equity? 40. So this is something which is decided. So whenever the company has specified optimum capital structure, so even one extra rupee which you have to raise, how will you raise it better? Can I say by optimum capital structure only? Come on, yes or no? Yes, sir. Acha. If I tell you that, if suppose you are raising 40,000 by the way of, if you are raising 40,000 by the way of equity, can I calculate what can be your total amount which can be raised by the way of your total capital employed? Come on, yes or no? Yes, sir. So sometimes now I can give you 40,000 rupees just by the way of equity. From that 40,000 rupees by the way of equity, can I calculate what can be the total amount which is supposed to be raised? Come on, yes or no? Yes, I can calculate on that basis also. So my dear students, always understand like this, that we have to take into consideration what is the optimum capital structure. That is very, 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 very important. Okay. See, read the question. ABC has the following structure, in which there is 14% debt, 11% preference shares, equity shares. Now this, they have told you optimum capital structure. Can you give me what is the percentage of debt now? If I take 30,000, if I divide that by 2 lakhs, can I say my debt will be 0.15? If I take 10,000 and if I divide that by 2 lakhs, can I say this is nothing but 0.05? If I take 1,60,000, if I divide that by 2 lakhs, so this is nothing but what? 0.8. So can I say the total is going to be 1? Okay. So the total is going to be 1. Are you all comfortable with this much part? So this is nothing but called as your optimum capital structure. Is this your optimum weights which is there? Come on, yaar. Is this your optimum weights? Come on, yes or no? Yes. Which is 0.15, which is 0.05 and 0.8. So any single extra rupee which you have to raise on the basis of this weights only. That is the meaning of optimum capital structure. Are you guys understanding this? Okay. The company's share price is bought 23.6. Next year, the dividend per share will be 50% of 2022's EPS. And following is the uniform trend of EPS preceding for the last 10 years. Just check for the last 10 years from 2013 to 2022, we have the EPS which is given to you. Can you just check, is the EPS constant or the EPS is growing? And can I say the EPS is growing at a constant rate of what? 10%. So my growth rate is 10%. The company issued new debentures. Now the company is issuing new debentures carrying 16% rate and the current market price is 96. Preference shares is 9.2 with annual dividend of 1.1 were also issued and the company is in 50% tax bracket. They are required to calculate cost of new debt, cost of new preference shares and cost of new equity shares, assuming new equities from retained earnings. So now, my dear students, we are required to calculate these 3 types of cost. Okay, first of all, how will you calculate your cost of debt? How will you calculate your cost of debt? Can I say your cost of debt will be calculated by taking interest into 1 minus tax upon net proceeds into 100? Solo yaar. Okay. Now please tell me, what is the face value? See, market price is 96. So obviously the face value will be what? 100. Acha, by the way, we are required to calculate cost of old debt or cost of new debt, beta? Cost of old debt or cost of new debt? New debt. So what is the face value? 100. Rate of interest is what? 16%. So can I say 16 rupees is your interest? What's your tax rate, guys? Your tax rate is nothing but 50%. And what's your net proceeds? Your net proceeds is nothing but 96. So what is going to be your final answer? 8 divided by 96 into 100. What is this answer going to be? 8.33%. What about the second part? KB. And KB, can I say that will be nothing but preference dividend upon what? Net proceeds into 100. What's your preference dividend? Your preference dividend, my dear students, what's your annual dividend? 1.1. What's your market price? 9.2. So now how are we going to calculate? 1.1 upon 9.2 into 100. Can you give me the answer? What is this going to be? 11.96%. And then third part, they have told you to calculate your cost of equity. But they have told you that this is nothing from your retained earnings. So from your retained earnings means normal calculation only. D1 upon, will I write down here NP or P0? P0, because this is retained earnings into 100 plus your growth rate. Can you please tell me now what's your D1? Guys, for your equity shares, they have told you that the market price is what? 23.6. So I'll divide that by 23.6. What's my growth rate? 10%. And what's your D1? So can I say your last dividend was, what was your last dividend, beta? They have told you your last dividend was 2.36. Right? They have given you last 10 years earning per share. So last earning per share is 2.36. How much percent are you giving by the way of dividend? How much dividend? 50%. So can I say 50% of 2.36 will be what? 1.18. Come on here. They have told you now that we are required to, see, read the question. The next year dividend is 50% of 2022's EPS. So that is nothing but 1.18. Now, will I add any growth rate to this? What do you think? The answer is no. Why? Because this itself is your next year's dividend. So this has to be 1.18. So what is going to be the final answer? 1.18, divide that by 23.6 into 100 plus 10. So can I say the answer is going to be 15%? So what's your answer? 8.33, 11.96, 15. Just check. 8.33, your 11.96, which is coming as they have rounded off to 12, and this is 15%. Have you all understood this? Okay, sure. First part is done. Second, calculate marginal cost of capital when no new shares are issued. Now, we don't have any weights, but we are required to calculate your marginal cost of capital, that is nothing but Q. How will we calculate Q, guys? So to calculate Q, we'll be having debt, we'll be having preference shares, and we'll be having retained earnings, which is reserves and surplus. Right? We can use this. But now in this particular case, what should be your weights? Tell me, what should be your weights? What should I take my weights as? Can I say it should be optimum? The one which I have just now calculated here in the question. This is my optimum weights. I told you now when the optimum word is given to you, so any new single rupee which is supposed to be raised, how will we raise it, beta? Can I say on the basis of optimum? Solo here. So now do I have the optimum weights? Come on, yes or no? Yes. What is that? 0.15, 0.05 and 0.8. Come on here. And now on the basis of this, what's my cost? My cost, as I told you, for retained earning is 15%. This is what? 8.33 and this is 11.96. Will I be getting my final answer? That is Q. Come on, yes or no? Yes, sir. Any doubts, beta? Okay. Next, third part. What is the third part of the question? Determine the amount that can be spent before new ordinary shares are issued. What is ordinary share? Equity shares. So before we issue equity shares, what is the new amount I can raise? That is something which is asked in the question. For that, do you have any reserves and surplus in the question? Now see, you have reserves and surplus. How do I have reserves and surplus? Just check. What was my EPS, beta? 2.36. How much dividend am I paying? 50%. So that is nothing but 1.18. What are my number of equity shares? What are my number of equity shares? Just check in the question. There are 10,000. So can I say at least I can use reserves and surplus of 11,800 for the purpose. 50% I'm giving by the way of dividend. So 50% I'm retaining. So can I use 11,800 for the purpose of expansion and growth? Come on, yes or no? Yes, sir. Now just check. This is the retained earnings. I can use it for the purpose of expansion. So we have debt, we have preference shares, we have reserves and surplus. Do I have the weights available? Yes, sir. What are my weights? 0.15, 0.05 and 0.8. Correct? Now, do I have reserves and surplus amount available? Yes. How much is that? 11,800. Can I get the total amount? Come on, yes or no? Yes. So you take 11,800 and divide that by 0.8. That is 14,750. So can I say 14,750 I can raise without even issuing one single rupee of equity share? And out of this 14,750, can I say I'll be having reserves and surplus? Yes sir, no sir? Yes sir. What will be that amount? 11,800. Will I be having any preference share capital? Yes or no, sir? Yes, sir. That will be 0.05. That is 5% of this. And then I'll be having my debentures, which is 15% of it. Got it, everyone? Okay. And then after that, what's the last part? They have told you, compute the marginal cost of capital when the funds exceeds the amount calculated in C, assuming new shares are rupees 20. So now if suppose I want to raise any single rupee, which is if I want to raise any new funds which is more than 14,750, then can I say compulsory I have to issue equity shares? Come on, yes or no? Yes, sir. I have to issue equity shares. I have to issue equity shares. Because now 14,750 I can use reserves and surplus. But now if I want to raise 20,000 rupees, is there any reserves and surplus which is there with me? No. Can I say I have to issue fresh issue of equity shares? Come on, yes or no? Yes, sir. So for that, what should be my new KE? D1 upon net proceeds into 100 plus G. Can you give me D1, guys? What's your D1? What's your D1? 1.18. What's my net proceeds now? 20 into 100 plus the growth rate is 10%. Can you give me this answer? 1.18 divided by 20 into 100 plus 10. 15.9%. Now, what is going to be the KO? I will have equity. I will have first debt, preference shares, equity. Do I have the weights available? Come on, yes or no? Yes, sir. 0.15, 0.05 and 0.8. And I have now KE as 15%. What was my KD? 8.33% if I'm not wrong. They had given now KD and 11.96. Now I will get my new KO. So if you want to raise anything above 14,000, then this is how we can raise it. Can you give me the answer now? 0.15 into 8.33, 0.05 into 11.96 and 0.8 into 15. The total is 13.85%. What? 15.9. Okay, sorry. 15.9. So this will become 0.15 into 8.33, 0.05 into 11.96, right? And then 0.8 into 15.19. How much is this coming? 13.99, which is approximately 14%. Is this coming as 14%? Just check. Because they have taken 12 now. We have taken 11.96. Rest everything is same. 15.9, 14.57. Understood this? Okay. That's it. So with this now all my illustrations are over. What are we going to do next? We'll be starting now with the practical problems. Okay. We have in all some 7 practical problems. We'll be doing that. We'll take a lunch break now. Okay. After that, we will continue with this. Okay. Chalo. I'll see you on 2:30, 2:35. We'll continue this further. Take a break. Check. Okay. So let's continue this further. Let's do this. Now we are doing practical problems. Okay. Let's start one by one. First practical problem. See what is given to you. Online students, you guys are there or you all have slept? Let me just check. After having so much of rice, I'm very sure. Where are my online students? 1 second. Yes. Online students, you guys are there. Come on here. The last chat was at 11:47. Where are you? Hello. Nitaji, Gautam. I think I have to take more 50 rupees from them now. Okay. Perfect. Shall we start? You guys can see me properly. Okay. Everyone please reply. Gautam, Vasantara, Nithaji. Okay. Chal. Let's start. So my dear students, now we are doing what? We are now starting with your practical problems and I want every one of you to please come to the first practical problem. Gamma Limited has 5 lakh rupee one ordinary share whose current ex-dividend market price is rupee 1.5. Okay, so ex-dividend. What is the meaning of ex-dividend? Can I say after the dividend per share? Okay, so that is the market price which is given to that is 1.5. Always remember that. even if the cum dividend price per share is given to you now, we have to convert that into X dividend by subtracting whatever is your dividend per share. Okay. The company has just paid a dividend of rupees 27 paise per share, and the dividends are expected to continue at this level for some more time. If the company has no debt capital, compute the weighted average cost of capital. Okay. So now in this particular question solution, what are you going to do? We are required to calculate what should be your KE. Come on, calculate your KE in the meanwhile. What is your KE? Okay, so your final answer is nothing but what? 18%. I hope you all have got this answer. Come on here. So this is nothing but 18%. Sure, confident? Okay, so there was nothing in this particular question. We just had to take dividend and we had to divide that by market price and we multiplied that by 100. We got your KE. Okay. Can I say this was nothing but dividend yield approach? Did you just check? Dividend yield approach. Your dividend was constant till perpetuity and there was no growth rate which was given to you. So that's why this is called as your dividend yield approach, and the formula for that is DPS upon MPS into 100. Okay. Chalo, let's start now with the second question. Now, what is given to you in your question number 2? The following details are provided by GPS. We have equity share capital, then we have 12% preference shares, we have 15% redeemable debentures, we have 10% convertible debentures. The cost of equity for the company is given to 16.3 and the income tax rate is 30%. We are required to calculate the WACC. How will you calculate your WACC? Same process, we have to prepare one table. Okay, and in that table, we'll be having what? We'll be having sources of funds, then we'll be having your amount, we'll be having weights, after tax, cost of capital and WACC. So how many sources do we have? We have equity, we have preferences, we have debentures, we have convertible debentures. Do we have the amount available for everything? Come on, yes or no? Yes, sir. So this is the total amount which is available. And we'll be calculating a WACC. And then what is the cost of capital? So for equity share capital, they have given to you 16.3%. So that is readily available. So we are going to just write down 0.163. Okay. Now for preference shares, can I say 12% will continue to remain as 12% only? Because there is no tax benefit which we get in your preference shares. But guys, when we are talking about your redeemable debentures, please tell me, have they given to you your life of the debenture? Just check the question. Have they given you the life of the debenture? So now in this particular case, if the life of the debenture is not given to you, we'll be using redeemable or irredeemable. Though they have told redeemable, but the life is not given to you. So that's why irredeemable debenture. So same concept, we have 15% your rate given to you. We can simply take 15% into 1 minus tax rate of 30%. So that will give you nothing but 10.5%. Okay. And what about convertible debentures? Same concept. 10% is the cost which is given to you. And post tax, it will be nothing but 7%. So then we have to calculate your WACC. So that will be 13.99%. Are you guys okay with this? Okay. Chalo. So with this, my dear students, we are done with your question number 2. Now I want you to please come to your third question. Okay. Now see what's given to you in your question number 3. ABC's company equity share is quoted in the market at what? Rupees 25. Okay. And the company pays a dividend of rupees 2 per share. And the investors market expects growth rate of 6% per annum. Now, when the company pays a dividend of rupees 2 per share, now what should you treat this as? Should you treat this as a D1 or should you treat this as D0? Then the answer is we should treat this as D0. Okay, so this is your D0, which is nothing but rupees 2 per share, and the investors market growth rate is nothing but what? 6%. What is required to be calculated? We are required to calculate what would be the company's cost of equity. How will you calculate your KE? Come on fast. Can I say 2 rupees? To this, we should add the growth rate of 6%. Market price is 25 into 100 plus 6%. So fast, do the calculation. Give me the answer. What's your KE which you are getting? So your answer is coming as 14.48%. First part is done. Very easy. Second part. If the company issues 10% debentures of the face value rupees 100 and realizes rupees 96 per debenture, can I say realizes rupees 96 per debenture is nothing but your net proceeds? This is the amount which you are realizing. while the debentures are redeemable after 12 years. So what's the life of the debentures, everyone? 12 years. So is this going to be your redeemable debentures bigger formula? Come on, yes or no? Yes, sir. And they are redeemable at a premium of 12%. Calculate cost of debenture using which method? YTM method. So I told you one shortcut. What was the shortcut, everyone? First, we can use the formula. Okay, what's the formula, beta? KD. Everyone tell me, what's the KD? Interest into 1 minus tax. What's your interest on 10% on the face value of 100 each? So what's your interest, everyone? 10. What's your tax rate? 50%. What's your redemption value? Are we redeeming this at a premium? Come on, yes or no? What's the premium, guys? 12%. So 12% premium, it means your redemption value will now become what? 112. Your net proceeds is nothing but what? 96. What's the life? 12. Life is 12 years, no? And divide that by 112 plus 96 upon 2. Give me the answer, guys. What is the answer which you are getting for your KD? Come on, fast. 6.09. So now, yes, you can take it somewhere between 5% and 10%. Absolutely perfect. So you can take between 5% and 10%. Can I say you will be getting your YTM approach, and based on that you can calculate this? Come on, yes or no? Yes, sir. What's the total amount which you have to receive? 96. So 96 is your net proceeds and we have to recover that 96 rupees. Okay. So we have to use YTM approach. What we have done in the previous questions, we are going to continue this further. So then your KD will be coming as 6.45%. So you have to take a range of 5 and 10% and then do that accordingly. So this one was your question number 3. Question number 4. Okay. Now question number 4, let's read this question. Masco Limited wishes to raise an additional finance of what? Rupees 10 lakhs for meeting its investment plans. So it has rupees 2,10,000 in the form of what? Retained earnings, which is available for investment purpose. And further details are as follows. This debt equity mix is what? 3:7. Cost of debt is given to you, which is up to 1,80,000 and beyond 1,80,000. Earning per share is given to you, and then we have dividend payout ratio. We have expected growth rate of dividend, which is 10%. Market price per share is given to you as 44 and the tax rate is given to you as 50%. Determine the pattern for raising additional finance. That's the first part of the question. What's the first part, beta? We are required to determine pattern for raising additional finance. So now, my dear students, question number 4. Can you please tell me how much amount is required to be raised, beta? 10 lakhs. So ये 10 lakhs में से now we have to divide into 2 parts. We have to take debt, we have to take equity. So debt should be what? 30%. Equity should be what? 70%. So can you please tell me 10 lakhs debt, 30%, what will be the amount of the debt, guys? 3 lakhs. And what will be the amount of the equity, guys? 7 lakhs. Okay. And in your equity also, do you have some retained earnings or no? What is the amount of the retained earnings which we have? So your retained earning is nothing but 2,10,000. So what is the amount of equity share capital? Can I say that is nothing but 4,90,000? Come on, yes or no? Yes, sir. So the equity share capital will be 4,90,000. And in this amount of the debt, we have your up to 1,80,000. So can I put it like this? Up to 1,80,000. What's the rate of interest, guys? 10%. Come on here. And then what about the balance part? 1,20,000. And for that, how much percentage rate we have to take into consideration? 16%. Okay, are you guys understanding this? Okay. So this is a pattern of raising the additional finance, which is the first part of the question. They have asked you the pattern for raising additional finance. This is the pattern which you can show it even in your examination. Absolutely fine. What's the second part of the question, guys? We are required to determine what should be the post-tax average cost of additional debt. So we are required to calculate post-tax average cost of additional debt only for the additional debt. So for the additional debt, my dear students, can I put it like this, that we are having sources of funds, amount, weights, after tax COC, and then the last part will be what? WACC. Can you give me what is your sources of funds, beta? Can I say there is 10% debt and then there is 16% debt? What's the amount which we have? We have 1,80,000 and then we have 1,20,000. Can you please give me what's the total amount, guys? 3 lakhs. So can you give me the weights, guys? 0.6, 0.4, total should be 1. Now, how do you calculate your after-tax cost of capital? Now, to calculate after-tax cost of capital, that is KD, we have to take interest into 1 minus tax. We can directly do it because there is no net proceeds applicable here. So we can directly take the rate and multiply that with what? 1 minus tax rate, you will be getting the answer. What's your interest rate, guys? 10%. 1 minus what's your tax rate? 30%. 50%. Yeah, it's 50%, right? So what is this going to be, beta? 5%. So your KD will be 5%. Solo yaar. And what is going to be this KD? 8%. So then you'll be getting your overall weighted average cost of capital. So what is this going to be? 3. And this is going to be 3.2. Your total is going to be what? 6.2%. Is that going to be your KO? Come on, yes or no? Yes, sir. This is going to be your overall cost of capital. Matlab, this is pertaining to your KD only related to your additional debt. It is any additional debt which you are raising, the cost is going to be what? 6.2%. Now, what's the third part? What is the cost of retained earnings and cost of equity? Please tell me, how will you calculate KE? Can I say D1 upon P0 into 100 plus G? Now, do you have your last year's dividend? Just check, we have earning per share which is 4 and dividend payout is 50%. So on 4 rupees, we are paying 50%. So this is 2, right? And what's the growth rate which they have given to you in the question? The growth rate which they have given in the question is what? 10%. What's the market price per share? 44. And into 100 and plus the growth rate is 10%. Give me the answer. 15%. So can I say if my K is 15%, what do you think is going to happen to my KR? Can I say my KR is also going to be dash? Can I say your K will be equal to your KR? That is going to be 15% only. Hello? You didn't got this. So your KE, KR both are going to be the same. And that is nothing but your 15%. Next, what is the last part? Compute the weighted average cost of capital after tax of additional finance. So now in this particular case, your fourth part is calculation of KO. How will you calculate KO, guys? So we'll be having sources, amount, we'll be having weights, then we'll be having after tax COC, and the last thing which we'll be having, that will be called as your WACC. Can you please tell me how many sources are there? So just check. So we have just checked, there is 10% debt, 16% debt, and now I will take retained earnings also, I will take equity share capital also. Though the cost is same, we can combine it also, but I'm just taking 4 individual costs because there is 4 sources which we have determined. Okay. So here we are having 10% debt. What else? 16% debt. What else? Retained earnings. What else? Equity share capital. I can do it in much more summarized format also by just taking debt and by taking equity, because anyway the cost is the same only. Okay. But just taking a longer route, this is 1,80,000. How much is this? 1,20,000. What's your retained earning? 2,10,000. What was your equity share capital? 4,90,000. What's the total amount? 10 lakhs. Can I say based on this, now I'll be getting the weights 0.18, 0.12, 0.21, 0.49. Do I have every source cost available? Come on, yes or no? Yes, sir. So the moment you do this, you'll be getting your KO, which is overall cost of capital. Superb. Okay. Everyone understood this? Okay. So with this, we are done with your question number 4. Now let's do your question number 5. Determine the cost of capital of best of luck using the book value and using the market value from the following information which is given to you. Now we are having book value and market value. Just check. Are we having equity share capital, retained earnings, preference shares, debentures? And then we are having book value and market value. Additional information is given to you, in which they have told you that equity shares will be quoted at rupees 130 per share and a new issue will be priced at rupees 125, which will be fully subscribed, and flotation cost will be rupees 5 per share. Now in this adjustment, the institute has done one mistake, which I'll show it to you in the solution. Okay. Dividend, they have told you during the 5 years is steadily increasing from 10.6 to 14.19, and dividends at the end of the current financial year is expected to be rupees 15. That is called as your D1. Preference shares, 15% of the preference shares with the face value of 100 would realize 105. And debenture, the company proposes to issue 11-year 15% debentures, but the yield on the debentures of similar maturity and the risk clause is 16%. Flotation cost is 2%. Corporate tax is given to you 35%. Ignore dividend tax. Flotation cost would be calculated on face value. This is specifically told you. Okay. Now we are required to calculate using what weights beta? Book value also and using your market value also. So can I say again we have to prepare how many tables? How many tables we need to prepare? 2 tables we need to prepare. Come on, yaar. So we'll be preparing book value and market value. But what about the cost? Do you think that the cost is going to remain the same? Hello? Whether it is book value weights or whether it is market value weights, is your cost going to remain the same? Come on. Yes, sir. So I want you all to do this along with me. Go to your notebooks. Let us practice this question. This is now solution to question number 5. Okay, are you all ready? So first give the heading. Calculation of WACC using what? Tell me. Book value weights. What will be the heading? Sources, amount, weights, after tax COC, and the last one is what beta? WACC. Okay, na? Now, how many sources are there? We are having 4 sources. What are the 4 sources? Equity share, reserves and surplus, preference shares, and debentures. What is the amount which you have? 120, then 30 lakhs, then next 36 lakhs, and then 9 lakhs. Okay. Do the total. 1 crore 95 lakhs. Okay, what are going to be your weights? Is this right? 1 crore 95 lakhs? Hello? Okay, now what is going to be your weights? 1 crore 20 lakhs, divide that by 1 crore 95 lakhs. What are you going to get? 0.62. Correct? Then 30 lakhs, divide that by, so this is going to be 0.15. 36 lakhs you divide by this, it will be 0.18. And 9 lakhs you divide by this, you will be getting what? 0.05. Come on here. These are going to be your weights. Similarly, we also have to calculate calculation of WACC using what beta? Using what we are going to take? Market value. Hello? We'll be having sources, amount, weights, after tax COC, and the last one is what? WACC. Correct? Now in this particular case, what is your sources, what is your details given? Equity share capital. Now please tell me, in this question, will your KE and KR be the same or KE and KR will be different? In this first, by reading the first adjustment, will the KE and KR be the same or KE and KR is going to be different? Of course, it's going to be different. Why? Because there is flotation cost which is given to you. So what are you going to do? You will be having, once again, equity share capital, reserves and surplus, preference share capital, and your debt. But now we have to write down all the market values. So preference shares market value is what? 33 lakh, 75,000. Come on here. And what about your debentures? 10 lakh, 40,000. Now, what is the market value of equity, guys? 2 crores. But this 2 crores needs to be now apportioned. In which ratio? Can you tell me which ratio will you apportion this to? Can I say we are going to apportion this on the basis of the book value of equity and reserves? Yeah. Right? So this 2 crores, what we will do? We will apportion in equity and reserves and surplus in the ratio of 120 and 30. So that is nothing but what? 4:1. So that is going to be what? 4 by 5 and 1 by 5. So this is going to be 1 crore 60 lakhs and this is going to be how much? 40 lakhs. So this is going to be 1 crore 60 lakhs and this will be 40 lakhs. Give me your total amount. Give me the total amount. Two crore 44 lakhs 15,000. Now what are your weights? Tell me. First I will take 2 crore 14 lakh 15,000 and now 1 crore 60 lakhs. I have to divide by this, so it is going to be 0.66. Come on here. This is now going to be 0.16. This will be 0.14. And the last part 0.04. Okay. The total should be 1. So are we ready with all the weights? Come on, yes or no? Yes, sir. Now what is to be done next? We have to calculate after tax of cost of capital. And can I say after tax cost of capital is going to be different for your KE and KR. Okay. Now in this particular question, the first thing is they have not given you growth rate directly. They have just told you that during the last 5 years now, dividend has increased from 10.6 to what? 10.6 to 14.19. But have they given to you at what rate is it increasing? No. So can you please tell me what's the formula for amount? Can I say A is equal to P into 1 plus I raised to the power n? So here, now what is the amount which is going to happen? Can I say after the end of 5 years the amount is going to be 14.19 here? Hello? 14.19. Now what is going to be your principal beta? Your principal is going to be what? 10.6 into 1 plus I raised to the power 5. So you take 14.19 and divide that by 10.6. What is the answer which you're going to get? 1.3387 is 1 plus I raised to the power 5. Now we have to calculate the fifth root, but not possible on a normal calc. But my dear students, can we do this with the help of the table? Come on, yes or no? Yes. We can definitely take the help of a table to calculate it. Now we just have to check the same FEIF. And in this FEIF table, please check what's the life beta. The life is 5 years. So I just have to look at this row. Okay. And now as you all can see that, yahan pe you all can just check that we have this as 1.338. Search if there is a 1.338 directly available or not. So is it directly available? Just check. Yes. Can you just check at the rate of 6%? It is directly available. So can I say that my growth rate is going to be what, beta? 6%. I hope you guys are trying to understand. See, this is the exact amount, 1.338. Okay. So on this basis, can I say that we are now getting your growth rate, which is nothing but 6%. Okay. Now, what is going to be your KE calculation? Can I say KE is nothing but D1 upon net proceeds? Hello? Into 100 plus G. Can you please tell me what's your D1 beta? Last year's dividend plus or growth rate. What was your last year's dividend? Just check. Dividend at the end of the current year is expected to be 15. So this is just dividend at the end of the current year. This is not dividend. This is D0 or this is D1. Dividend at the end of the current financial year. What will you treat this as? This is fifth. No? Hello? So that will be treated as your what? D1. Because dividend at the end of the current financial year is expected to be. Can you see the wordings? So this is last year's dividend or this is going to be next year's dividend. Now this is very important to identify because growth rate depends on it. So are we going to add any growth rate to it or there is no growth rate we have to add? No growth rate. So this is going to be what? 15. What's the net proceeds, guys? The net proceeds is going to be, we have issued it at 125 and flotation cost is 5. So can you please tell me 125 minus 5? What will this give you, beta? 120 into 100 plus what's the growth rate? 6%. Chalo, give me the answer. This is coming as 18.5%. Everyone is getting the KE as 18.5. Hello. So now I have got my KE. Can I substitute KE as 18.5? 18.5. 18.5. Let's talk about KR. Can you please tell me now in KR calculation, I will take D1 upon what? P0 into 100 plus G. That's how I'm going to calculate your KE. So can you all please tell me what's your D1 beta? 15. But what should be the market price? Then the market price are quoted at 130. So you have to divide that by 130. This is where institute has made a mistake. Give me the answer. What is the answer which is coming? 17.54%. So this is your KR, 17.54%. Can I go and substitute my KR also? Come on, yes or no? Yes, sir. I can substitute my KR also 17.54%. Now here what ICAI has done is, by mistake now they have taken here 125. It should not be 125. What it should be? It should be nothing but your, how much percent? They should be 130 rupees. This is the error. In the illustration which we did, illustration 12 or something, in that they had taken market price only. But here it's a mistake. Okay. Convinced everyone? Okay. Next, after that, what's the next thing which we have? 15% preference shares with a face value of 100 would realize what? 105. So now please tell me, KP redeemable or irredeemable, everyone? Is the life given to you or life is not given? So then that particular case, what I will do? I will simply calculate my KP. How will I calculate KP, guys? Can I say that is PD upon net proceeds into 100? What's my PD, guys? 15. Because 15% of 100 is 15 rupees. What is the net proceeds? 105. They are given in the question. It is nothing but 105. So give me this. 14.29%. Can I now substitute my KP, which is 14.29%? Do you guys get this? 14.29. Now what's the last thing? The last thing they have told you that debentures, the company proposes to issue 11-year 15% debentures, but the yield on the debentures of similar maturity and risk class is 16%. Flotation cost is 2%. Now, what we want to do is, we want to issue the debentures. See, if in market now people are buying debentures and they are getting 16% rate. If I issue debentures at 50% rate, will people buy my debentures? Because already there is someone who is selling this particular debentures and providing the interest rate of dash. My competitors are providing 16. But if I issue the debentures at 15%, what do you think people will subscribe to it? No. So to make them subscribe, don't you think I should issue those debentures at some discount? Because only if I issue a discount, people will buy my debentures. Come on, yes or no? Yes, sir. So what is going to be my issue price? So see, what am I going to do is, can I say on face value 100, dividend of 16 is given. Now in this particular case, if I keep 15% rate, so what should be my issue price? On 100 rupees issue price, the interest which is being given, that is 16. Come on, yaar. The interest given is 16. But if I am providing 15, then what should be my issue price? 15 into 100 divided by 16. How much is this? 93.75. So can I say my issue price should be 93.75. But don't you think from the issue price I also have to subtract dash? Flotation cost. So now what is the flotation cost? They have mentioned beta. They have mentioned flotation cost of 2%. 2% of the face value 100. So 100, because they have only told you now that flotation cost is nothing but 2%. So that is going to be your 2 rupees. So what is going to be your final answer, beta? So this should be treated as your net proceeds. And by the way, it proposes to issue 11 year. Can you please tell me now, KD will be calculated using a smaller formula or bigger formula? Bigger formula, right? KD redeemable. What is your interest, everyone? What's your interest? Just check. Huh? 15%. So this is going to be 15 into 1 minus. What's your tax rate? 35%. Plus, what's your redemption value? Par 100. Net proceeds is 91.75. Life is 11. And you divide that by 100 plus 91.75 divided by 2 into 100. Give me the answer. What's your KD? %10.17%. 10.95 is the answer. 95 only is coming, na? 10.95. So this is your KD 10.95. So then can I substitute here 10.95% on yes or no? Yes, sir. And this will actually help you to calculate your KO. I'll be getting my KO. Okay. So very easy, beta. I hope you have understood how do we calculate this. Sure, confident. Okay. Chalo, good. Now let us start with the next question. Question number 6. Okay. What is given to you? Kalyanam Limited has an operating profit of 34 lakh 50 and it has employed debt which gives total interest charge of 3 lakh 75,000. Guys, operating profits is also called as your dash EBIT. And the firm has an existing cost of equity and debt which is 16 and 8. And the firm has a new proposal before it which requires fund of 75 lakhs and is expected to bring an additional profit of what? 14 lakh 25,000. To finance the proposal, the firm is expecting an issue of additional debt of 8% and will not be issuing any new equity shares in the market, assuming no tax. You are required to calculate WSCC before the proposal and after the proposal. Okay. Now, how will you approach this particular question? See, guys, in this particular case, what are the two sources? Okay, just check. What's the amount of the EBIT which they have given? This is now solution to which question? 6. What is the amount of EBIT which you have? 34 lakh 50. Okay. And also at the same time, they have employed a debt which gives an interest charge of 7 lakh 50. So we have the interest charge which is 7 lakh 50. Hello? Okay. But do you have the amount of debt available? I'm asking you, do you have the amount of debt available? There is no debt. Till now. The firm has an existing cost of equity of 16%, cost of debt is 8%. So we have your K, which is nothing but what? 16%. And we have your KD, which is given to you as what? 8%. And it has a new proposal before which it requires a fund of what? 75 lakhs. And this will bring the additional profit of what? 14 lakh 25,000. So can I put it like this, that because we are going to raise 75 lakhs, your EBIT will increase by how much amount? 14 lakh 25,000. And to finance this, the firm is proposing an additional debt of what? 8%. And will not be issuing any new equity shares in the market. So can I say entire fund? What is the investment which is happening in the fund? 75 lakhs. Can I say the new funds of entire 75 lakhs is what, beta? Can I say it is nothing but by way of debt? There is no equity in it. How will you approach this? So in this particular case, first we will get the amount of debt. How much is the amount of debt, beta? 93 lakh 75,000 existing debt. Okay, so this cost of debt, now we have to consider this as before tax cost of debt. And anyway, there is no tax rate which is given to you. They have told you there is no tax culture. So that's why can I say whatever is your cost of debt, that itself is nothing but your rate of interest. Come on, yes or no? Yes, sir. Or else there would have been into 1 minus tax. But there is no such data which is given to you. Okay. So based on that, we got first the amount of the debt, 93,75,000. Is everyone okay with this? Okay. What is the value of equity? Now EBIT minus interest, what do you get? EBT. So 34,50,000 minus 7,50,000. How much is this gonna be? 27 lakhs. Is there any tax? Is there any preferences? So all the profits belongs to whom? Come on, yaar. Equity shareholders. And then they have told you that what is the cost of the equity which they have told you, that is 16%. So you just have to take this amount, what we have just now got, 27 lakhs, and divide that by how much percentage? 16%. In case of debt also we are taking interest and we are dividing that by the interest rate. So we are capitalizing it, right? So here also we have the net profit for equity shareholders. We'll capitalize that. How much is the answer? 1,68,75,000. Have I got the value of the equity also? Come on, yes or no? Yes, sir. Now, what is going to be your new KE? See, this is now going to be what? 34,50,000 plus 14,25,000. Can you give me what is this going to be? 34,50,000 plus 14,25,000 after expansion. See, all this is before expansion. After expansion, can I say the EBIT will be 48,75,000? Hello? From that EBIT, what will I subtract? Interest. What will I get? EBT, also known as my dividends. Right? What will be the amount of the interest, everyone? Can I say we have taken new funds at the rate of what? 75 lakhs. What's the rate? 8%. So 75 lakhs multiplied by 8%. How much is the interest? 6 lakhs. And how much was my old interest? 7,50,000. Now I am doing it after expansion. This is after proposal. So that is going to be 13,50,000. So 48,75,000. I will subtract it with what, beta? 13,50,000. What am I going to get? 35,25,000. Hello? Are you all trying to understand this? So this is nothing but 35,25,000. Now, my dear students, to finance the proposal, the firm, so we are required to calculate what a WACC. Okay. So we have got this as 35,25,000. Okay. And what my new KE? So because there is no further equity which is supposed to be raised, so 35,25,000, if I divide that by what's my value of equity? Your value of equity which is given to you, that is nothing but how much? We have already calculated this above. Okay, you only did it for me, which is 1,68,75,000. So will I get the new KE? Come on, yes or no? Yes, sir. Now, what will be your format? See, sources, amount, weights, cost of capital, WACC. Correct? If I am talking about before proposal, so can I say there will be debt and equity both? What was the amount of the debt we got it through capitalization? 93,75,000. So, yaar. And what is going to be the amount of equity? We got this as 1,68,75,000. Come on. What was your cost of capital debt? 8%. And equity before proposal was what? 16%. Can I calculate the amount, weights, WACC? Right? Is this part okay? Will I be able to get it? Okay, so if I give you interest amount and if I give you rate of interest, can you calculate value of debt? Come on, yes or no? Yes, sir. Similarly, if I give you dividend amount and if I give you along with dividend, your capitalization rate, that is KE, can I say we'll be getting the market value of equity? Come on, yes or no? Yes, sir. So this is before proposal. After proposal also we have debt and equity. So what is going to be your debt? Now our debt is going to be increased. Hello? 75 lakhs old and 93,75,000 old and 75 lakhs new. So please take 93,75,000 and add 75 lakhs to it. So can I say this is going to be 1,68,75,000. Correct? And value of equity I just now got. What was the value of equity which I got? 1,68,75,000. So can I say this is Going to be 0.5, 0.5. This is 8. And the new KE which I've got, that is nothing but 20.9%. Will I be getting the WACC? Come on, yes or no? Yes, sir. You'll be getting the WACC. See, half of proportion. 14.45. Are you okay with this? Okay. Last question. Question number 7. A company issues 15% convertible debentures of rupees 100 each at par with a maturity period of 6 years. So guys, this particular debentures is going to be redeemed when beta? It is going to be redeemed after the period of 6 years. But what have they told you? On maturity, each debenture will be converted into 2 equity shares of the company. Matlab at the end of the 6th year, can I say, are you going to get cash or are you going to get equity shares? And for one debenture, how many equity shares are there? For one debenture, there is 2 equity shares. Risk-free rate is 10, market risk premium is 18, and the beta is 1.25. Can you calculate KE, guys? Come on. Can you calculate KE? What would be the formula? RF plus what? RM minus RF into beta. Bolo yaar. What's your RF, everyone? 10. What's your RM minus RF? They have told you market risk premium, which is that 18%. What's your beta, guys? Your beta is nothing but, they have told you in the question, how much is it? 1.25. Is this sufficient for you to calculate your key? What's your key? 32.5%. Hello? 32.5%. Is this your KE? Come on, yes or no? Yes, sir. Just check. Your KE is coming as 32.5%. But then what have they asked you? The company has paid a dividend of rupees 12.76 and 5 years ago it paid a dividend of rupees 10. Flotation cost is 5%. Okay. Now you are required to calculate what is the cost of convertible debentures using the approximation method. Now approximation method means that formula which I told you. This formula is nothing but approximation method. Can you just check this formula? This is nothing but your approximation method. Okay. So how do you calculate your KD? Interest into 1 minus tax. Plus, instead of RV, I will write down conversion value. Why will I write down conversion value? Because at the end, are you going to get it converted into cash or you are going to get it converted into shares? Shares. So conversion value minus net proceed upon what? N, and divide that with what? Conversion value plus net proceeds upon 2. Solu yaar. Okay. What's going to be my amount of interest? Just check. So can I just check that the interest is what? 15% of face value 100. So it's going to be 15. What's the tax rate, everyone? Tax rate, 40%. Now I need conversion value. So what have they told you next is that you are having one debenture is equal to how many number of equity shares? 2 equity shares. But I don't have what should be the price of this particular equity share. But now I can calculate this price. First, I will calculate P0. What is the current market price today? Only if I have current market price today, I will be able to calculate what can be the price at the end of 6th year. We did one question on convertible, example 3, in which we had to calculate what should be the conversion value. Do you remember I told you the price today is this much, 153.12, the answer. So the same thing is applicable here. First I should get what should be your P0 and then I'm going to add the growth rate for how many number of years? 6 years. Then I'll be getting conversion value at the end of the 6th year. So how do you calculate P0? See, as per dividend yield approach, what is KE? D1 upon P0 into 100 plus G, right? So if I want to calculate P0, I'll take first year G. So this is KE minus G is D1 upon P0 into 100. Solo here. So if this P0 will go here, so can I say this will now become what? D1 upon KE minus G. That's how I can calculate the price today. Come on, yes or no? Yes, sir. Can you please tell me what was your last dividend? the company has paid a dividend of 12.76. Okay, and they have told you that the 5 years ago the dividend was 10. Okay? So first I'll write down here 12.76 plus I have to add the growth rate. The K which I just now got was how much? 32.5. Hello? And I need to just calculate the growth rate. Now how will I calculate the growth rate? See, they have told you that 5 years ago it paid a dividend of what? Rupees 10. So amount is equal to principal into 1 plus I raised to the power n. Okay, 5 years ago I had paid a dividend which was how much? Rupees 10. What is this? Price has now become 12.76 into 1 plus I raised to the power 5. Okay, it's coming as 5%. 1.276 is equal to 1 plus I raised to the power 5. So your I is coming as 5%. So can I write down this as 5%? Come on, yes or no? Yes, sir. So I can get my P0. So what's my P0? Can you please calculate this for me? 12.76 plus 5% will give you 13.398 upon 32.5 minus 5. That is nothing but 27.5. So now this will be 13.398 divided by, this is percentage. Okay, you can write down into 100 also, or you can write down your percentage also. Divide by this percentage will give you 48.72. Now how many equity shares are going to get? 2 equity shares. But wait, this is just your dash. Is this your P0? Come on, yes or no? Just check. Your P0 should be coming as, how much is it coming? Actually, they have directly done like this only. Okay, no problem. So, okay. So now, my dear students, there are 2 ways to do it. Okay, but what we will do is, chalo, everyone is okay with this much part first. Okay. Now, just do one thing. Add growth rate 5% for 6 years. Just do that. 1, 2, 3, 4, 5, 6. See, same answer, 65.28. Are you getting it? So what you can do is, you can take 48.72, but this is the price what? This is the price today. I want the price at the end of which year? 6th year. So what is going to be the price at the end of 6th year? If I take 48.72 and add growth rate, how much is it? 5% for 6 years. In example 3, we did it like this only. That's why I'm following this method. So which is 48.72 into 1 plus 0.05 raised to the power 6. So that will give you 65.29. So this is 65.29. This, because I've got the P0 first. Because P0 was not given to you, na. They had told us that, okay, 5 years ago this was the dividend. Right now this is the dividend. Based on that I calculate the growth rate. But I want P0. P0 was not given to you. So I calculated P0 first. And once I calculated P0, now the growth rate is dash 5% for how many number of years? 6 years. So will that give you your final answer? Come on, yes or no? Yes, sir. So much is this figure coming, beta? 65.29. Are you clear? Okay. So this rupees 65.29 is what? 1 share. Price is 65.29. How many shares am I going to get? 2. So you multiply this by 2. How much is this going to be? 130.58. So what is 130.58? This will be called as my conversion value. So which is 130.58. Got it? Okay. Flotation cost, they have told you 5% of the issue amount. So 100 rupees at par. So this is going to be what? 95. What's the life? 6 years. And this will now be 130.58 plus 95 upon 6 into 100. So I first calculated what is going to be the price, and based on that we calculated, we'll be getting the final answer, which is nothing but what? 13.24%. Superb. That's going to be our KD. Have you all understood this calculation, guys? Okay. So first I calculated P0 because P0 was not there in the question. So first I calculated a P0 and then I calculated the price at the end of the 6th year. Okay. We are also required to calculate YTM method, cost of preference shares. Now this is something which you have done it many number of times. So you'll be able to do it. Okay. So using IRR method, we just have to calculate it. What is going to be my P0? Flotation cost is 6% of the issue amount. So 94. So you should try and get 94 rupees. Series of cash flows will be given to you. You use trial and error method, you'll be getting the answer. Okay, everyone is convinced? With this now, my dear students, finally, a very big chapter gets over. And that is your cost of capital. Understood, everyone? Sure, confident? Purinjida? Arthamainda? Okay. Now we are going to start with a new chapter. We'll take break of 5 minutes. After that, we'll start. With a new chapter, we'll start. Check. Okay. Sure, my dear students. We'll continue this further. Okay. Now we are starting with a new chapter, and that is financing decisions, capital structure. Okay. Now see.